Audio Jungle.
Hello guys, welcome back. In today's video we are going to talk about Forex. What is Forex? We're going to basically talk about introduction to Forex in today's video, and some of the modules we're going to be covering is what is Forex, history of Forex, what is traded in Forex, the foreign exchange market participants, cash flow explained, trading sessions, brokers, types of brokers, how to protect yourself against brokers scam, and ultimately Forex jargons, most likely. So what is Forex? What is Forex? The simple way to define Forex is foreign exchange. Now, most people have asked this question over and over again. The short form of Forex means foreign exchange. Now, Forex, which is foreign exchange, is any form of exchange that requires conversion of an asset to another in the global financial market. And this, as I mentioned, is referred to as foreign exchange. Different assets can be exchanged in the Forex market. You can trade gold, you can trade oil, you can trade metals, you can trade currencies, agricultural produce, etc., etc. There are different ways to do this. For example, Russia can decide to exchange arms for oil with Iran. When you are traveling at the airport, you can decide that, okay, I've seen some boots that I like, I want to exchange this for another currency. Now, that normally is the usual day-to-day exchange that we do. But now, bringing that home into Forex, if for example you're in Nigeria, you want to travel to the United States, you can decide to exchange your naira, because Nigerian currency is naira. You can decide to exchange your naira for dollar. In this case, you have sold your naira, but remember, as you're selling the naira, at that same time you're automatically buying dollars. There is no way you can sell naira and you won't buy dollars. It goes hand in hand. Now, if you had to go back home to Nigeria, you would have to exchange your dollar that you have in the United States. You have to sell that dollar and purchase naira, because when you come back to Nigeria, what you would be needing in Nigeria as legal tender is the naira. So Forex is an everyday activity, and it's not just something you do between one country or two nations. It's something that has come to stay worldwide. Now that we know what Forex is, how did this all start? What is the history of Forex? Now, Forex started way back before our time today. It's been a long time ago. Now, how did this all start? It started by barter, trade by barter. The history of Forex is what we're talking about right now. Forex started by a bartering system known as trade by barter. Now, from trade by barter, it evolved to several units of exchange which was unique for each country. For example, we start with the bartering system. If, for example, you were in an era where the bartering system was in play, people use what they have to get what they want. If, for example, you are a farmer and you produce rice, you produce cocoa, you produce different agricultural products, and now you have food. But in this case, you know that at this point in time, food is not your problem. You need something else. Let's say in this case you need let's use a simple example. You have food, you're a rice farmer, but at this time you do not have other things. Let's say you need pepper from other farmers, but you're not a pepper farmer. You can decide to exchange your rice for pepper from these other farmers. That is how the bartering system works. But then over time, because it cannot be used to properly know what is the value of what you have in exchange for what you're getting from the next person, it was deduced that mankind realized that it was not a fair way to know the value of your product, or it's not a fair way for exchange. Then men decided to make the use of gold as a form of exchange. So people started using gold to exchange for commodities. So in this case, you want to buy anything at all. Let's say you want an electric fan. You can decide to use your gold to get an electric fan. Now remember that trade by barter, it's something that was not easily accepted. For example, in some areas of Africa, for example, you cannot exchange what you have with countries like China. For instance, the local yam made in Nigeria is something that will not be needed in a country like China. So imagine a Nigerian needing electrical products from the Chinese, like an air conditioner or an electric fan. You cannot use your yam that you produce to get an electric fan because the Chinese do not need your product. Hence, people needed a universal form of exchange, and that was why they started using gold. So, when the use of gold started, people were actually happy with this because you can now get what you want with what you have, which is gold. But there was a problem. People started hoarding gold. This simply means that there was a saying where they said, "He who has gold makes the rule." So remember, the reason why there is a form of exchange is because demand and supply should always circulate. So since people were hoarding gold, once they have that gold, they do not want to release it because it's so precious to them. There was a fault in there. The need for demand and supply was no longer met because people who had gold were hoarding it. Remember, for something to be used as a form of legal tender, demand and supply must be met. So there was a high demand of gold, but there was not enough supply for it. Hence, people were hoarding it. This simply means that people can no longer use gold because demand and supply was not met. There was no equilibrium for demand and supply, and this is what we're trying to gain in the financial foreign exchange market. Now, a lot of countries have either gold. It got to a point where people said, okay, this is what we're going to do. Because people were holding gold, we need a currency, a form of exchange where individual countries, their exchange is backed by a third party currency or asset. Now, different countries, they had their currency. The agreement right now is that you as a country, you cannot measure the value of your currency except you compare it with the exchange of a third party country's currency. For example, if you are in Ghana, you won't know the value of your cedis except you measure it with the currency of another country. Hence, people came together, the world came together, and they decided that the United States dollar will be used as the foreign reserve. This is to support the value of their currency and of third parties' currencies from other countries. Now, why the United States? It is simple because the United States, they hold the largest amount of gold and a couple other factors. So that is why in most cases right now in Nigeria, you might be hearing statements like, what is the value of $1 to Naira today? Now, you knowing that value, it affects everything that happens in a particular country because the value of your currency changes every single time with respect to the United States dollar. That is the best way to measure it. Like I said earlier, demand and supply is money. Demand and supply determines the value of currencies and assets. The note you use in your country to make purchase is fiat. Money is the value that backs your fiat. Money is dynamic, which makes it static. Now, demand and supply is money. Demand and supply is exchange. You will hear a lot of times I'll be talking about demand and supply because the foreign exchange market is governed by demand and supply. Now, remember, so far we've defined Forex. What is Forex? And we've talked about a brief history about what Forex is. If you want to know the complete history of what Forex is, you can go to my YouTube channel and find the video history of Forex. You find it there and you get the full history of foreign exchange. Now, what is traded in Forex? A variety of assets are being exchanged across countries of the world. The most popular of these assets are currencies. So every single day, people trade different things, and the most popular among them is currencies. In the Forex market, we largely trade currencies, metals, oil, stock, futures, and cryptocurrencies. These are generally things that are being traded in the foreign exchange market. Now, in some cases, when we say Forex, some people, their minds just quickly run down to the currency market, like euro, dollar, Japanese yen, dollar, the pound dollar, the cable. These are what their minds go to, but they forget to realize that in as much as the currency market, which I mentioned, has a large and is one of the most popular parts of the Forex industry, we also have cryptocurrencies, we also have stocks, futures, metals, and oils just as well. The list goes on and on. It may interest you that the world's total liquid asset is about $90 trillion. The world's total liquid asset is about $90 trillion. And out of this $90 trillion, currently we have about $7 trillion being exchanged daily in the foreign exchange market. Now, this makes the forex market the largest. It is larger than the stock market. It is the biggest market in the world. Now, what you should be asking yourself is, yes, it is quite interesting. $6 trillion. I'm not talking about $6 billion. No, $7 trillion. Excuse me. $7 trillion being traded every single day, 5 times a week, Mondays through Fridays. And then in some cases like cryptocurrencies trades even Saturdays and Sundays. So about $7 trillion rather. So when this article was written, it's about $6 trillion to tell you the growth of the foreign exchange market. And more money are coming inside this market every single day. Now, yes, of course, this figure is much, $7 trillion. You should be asking yourself, if it's true that $7 trillion is being traded, is being exchanged every single day, what can I get from this? Well, as you go on, you're going to know how that is going to help you. Now, you already know that instead of struggling with the little resources within your country's gross domestic product, you can take part in the foreign exchange market and make money without limits, because we have $7 trillion to be traded every single day. Would you just sit at home and fold your hands while you can also partake of this? Or you can actually get to work and do something about it. We're going to talk about market participants, forex market participants. Now, this part is very, very important. Very important. You have to know this. You may be wondering who are the people or who are the market participants that contribute to this enormous sum. We're talking about $7 trillion every single day. It is good for you to identify these major players in the market. Now, of course, if you're watching this video, it's very obvious that you don't have $1 trillion, because if you have $1 trillion, you won't be watching this video. There are big boys in this market, and we are going to talk about these big boys in the market. We're going to categorize traders in different categories. That is what this module is about. Forex market participants. Who are the people who trade the foreign exchange market? We have 4 in this category. 4 different market participants. The first in these categories is the government. Every country, every single country have trade allies. They have trade allies with other countries. For example, the Chinese government may decide that they want to buy American soya. Now, when they want to buy American soya, the Chinese currency is called Chinese yuan. Yes? The Chinese will not just decide to use Chinese yuan to buy American soya. Of course not. They would want to sell that Chinese yuan and buy the United States dollar in order to purchase American soya. Now, when they do this, remember, they are exchanging a large sum of money. We know how government operates. When they want a project, they do it big. We're not talking about thousands of dollars. We're not talking about millions of dollars. Sometimes it can go into billions of dollars. So when they buy American soya, they are doing this by exchanging their currency, the Chinese yuan, to the American dollar. Of course, when they exchange this dollar, it means that they are participating in the foreign exchange market. Imagine Chinese selling the yuan to buy American dollar. What do you think would happen to the American dollar? Because they are putting in so much money into the American dollar. Of course, we expect the dollar price to go up. Yes, it has to go up. So this is one way in which they participate in the foreign exchange market. Now, this is what the Chinese do. How about the Americans? Because we're talking about allies here. Every country have allies. The Chinese, they buy American soya. It won't just be one-sided. So the Americans, they'll say, okay, we want electronics. So the Americans can decide to buy electronics from the Chinese government. Or in most cases, since the Americans, they are already developed, they can only decide to buy American soya from the Americans, and then Chinese will come to Africa, for example Nigeria, to sell their electronics. Now, Africans have to convert their currencies to dollar in order to pay for the Chinese electronics, or they have to convert their currencies to the Chinese yuan in order to pay for these electronics. And while doing this, foreign exchange is taking place. So in this market, in the Forex market, there is something else that we would pay attention to. We pay attention to the government when they have problems with one another, when flow of money is altered. For example, the United States might sanction Iran. Iran, as we all know, is an oil producing country. They might sanction Iran on violation of nuclear deal. Now, the deals that are supposed to be coming to Iran, which are of course billion-dollar deals, the billions of dollars that are supposed to come to Iran, they will channel that, because since the United States have sanctioned Iran, there is not a problem between them. The deal would simply go to another country, another oil producing country, for example Nigeria. So when this happens, what would naturally happen to Nigeria's currency, which is the naira? Of course, we would have gains in Nigerian naira. It will be strengthened. So this is how the government participates, and this is how the activities affect the Forex market. Another participant we have are the central banks. When I mean central banks, they are selected central banks here. I do not mean the Central Bank of Nigeria. In fact, Nigeria Central Bank do not fall under this category. When we get there to what category they fall under, I would make it known. Now, the central banks, we have banks like the Bank of Japan, the Bank of England, and of course the Federal Reserve. They regularly involve in the Forex market. The Federal Reserve, as we know, belongs to the United States. The Bank of Japan to Japan, and the Bank of England to England, United Kingdom. Now, the central banks, they participate in the Forex market for their operations, international payments, international trade payments, and handling their foreign exchange reserve. Meanwhile, central banks affect the Forex market when they adjust interest rates to control inflation. They can also affect it by direct intervention. For example, it will interest you to know that some countries would love to see their currency to be low. They want to keep their currency low. Yeah, I know in your head you might be thinking something right now. Why would a country want to keep their currency low? Good question. I want to give an example. Japan, for example. Japan, they are fighting inflation. And as we know it, Japan is an export-based company. This simply means that for them to survive, for them to do well economically, they have to base their hope or their business on exports. So, Bank of Japan, they will not mind pumping in millions of yen. Yes, Japanese currency is called yen. So, the Bank of Japan would not mind pumping in millions of yen into the market in order to keep the yen low. Now, you would be asking, why would they want to keep it low? Well, since they depend on other countries to patronize them for them to survive, they have to ensure that their currency does not become expensive. Let's say you love cars. Yes, you love Japanese cars, and you want to pay a visit to Japan, to get a car for yourself. Would you be likely to do business with the company in Japan that you want to get the car from if their currency is low or if it is higher? Of course, you'd want to patronize them when the currency is low, because you do not want to get these things so at a very expensive rate. So that's why countries like Japan would want to keep their currency low so that it won't be too expensive for traders and businessmen to do business with them. So this is another way in which the central bank participates in the foreign exchange market. Now, remember, we're talking about market participants. So far, we've talked about the government, and now we've talked about the central bank. The next participants that participate in the foreign exchange market, they are the commercial traders. The commercial traders, they are the big boys in the market. They include big financial institutions, the banks, financial servicing companies, etc. And we also have examples like Chase, Barclays, they come into the market not just with little money, but they come in with lots of money. When I mean lots of money, I'm talking about billions of dollars, not naira, billions of dollars. Their decision on what currency to buy or sell can make the market move considerably. Now, these commercial traders, of course, they are not central banks like we mentioned earlier, but they are big institutions, big financial institutions and servicing companies like the example we gave. And when they come into the market, you feel the effects readily because they are coming in with billions of dollars. Now, what other category of traders do we have? We have the retail traders. Yes, the retail traders. And in this category, this is where you fall under. This is where myself, individuals trying to take advantage of these money flow around the world, this is where we all find ourselves. Now, why are we called retail traders? This is because the money that we bring to the market is relatively small compared to what the commercial traders, compared to what the central banks, and compared to what the government will bring in to the market. So, as retail traders, we try to take advantage of the market by trying to use technical and fundamental analysis. We'll get there, what this means, in order to trade along with these commercial traders, the government, and the central banks. So, we have 4 market participants: the government, the central banks, the commercial traders, and of course the retail traders. Now we're going to move on to the next module, cash flow. We are going to explain what this means in the Forex market. Now, in Forex, we are not just concerned about chasing money, we are concerned about where the money will be going next. The emphasis is on next, not where money is currently. It is where is the money going next. Now, it is very important we know this because this is where most investors, most traders, this is where they get it wrong. The big boys in the industry, the commercial traders, the banks, and the government, they understand this principle, and that is why they use this principle to attack people who are not informed in the market. So what they do, they use a strategy of buy the rumor and sell the facts. Yes, because they know when they are buying the rumor, you will be scared from the market because it's a rumor. You will be selling to them while they are buying it, and then they sell the facts. Money moves in cycle as you progress in life, so money is in constant motion. People would want to chase money, they will want to rush towards where money is, and they have no idea, or they are not thinking of the possibility that, look, this money they are chasing, the money will leave there soon and go to somewhere else where there is more demand. Demand, as we know, it can be created, it can be man-made. So how do experienced traders, how do they make use of this information? You buy when price is low, you buy these assets when they are cheap, and then you sell them when the price comes high. These opportunities, they are foreseen demands that will attract the flow of markets to create a balance. Like we said, money is in constant motion. In fact, the world is in constant motion, and the forces of demand and supply, we always want to attain equilibrium. So when price is in demand, it would want to go to supply. When it's in supply, it would want to go to demand, because it has no choice, since it's trying to attain equilibrium. Although this never happens, but it's what it's trying to achieve. So because of this single fact, price will always, all the time, be in constant motion. So, Forex trading sessions. Forex trading sessions. We basically have three major, there are other trading sessions, but we're going to mention three major trading sessions. Every other sessions you find, they overlap these sessions and they are not so important, or they are just attached to these sessions. Now, the first session is called the Tokyo session. This Tokyo session, we can also refer to it as the Asia session. The Tokyo session, the London session, and the New York session. Now let's take the first one, the Tokyo session. The Tokyo session is also known as the Asian session. It is also known as the Asian session. During this time, the major activities are centered in Asia, in Australia, and in New Zealand. What this simply means is that if you're a trader during the Tokyo session or during the Asian session, there are particular currency pairs that you would want to focus on. Why? Because these currencies, they are usually currently awake or in session during these sessions that we want to categorize. For example, Tokyo session, we have banks in Asia, banks in Australia, and banks in New Zealand. During Asian session or Tokyo sessions, these banks will be open. That is their session. So while you're trading as a trader, you want to take advantage of this knowledge that you know to trade pairs that are found in these locations. For example, the JPY is the Japanese yen. The Japanese yen, the Aussie dollar, that is the Australian dollar, the New Zealand dollar. These are all currencies that are located in Asia or in Tokyo. The liquidity at this time, that is the Tokyo session, is the lowest because major financial operations at the West are not operational at that time. What does this mean? Liquidity, which is movement of money at this time during Tokyo session, is not so much. The reason for this is because most banks are found in the West, in the United States, and that's where most financial operations are located. So the Tokyo session do not have operations from the West because by that period they have closed, or they'll probably be during their late evening, night hours. Now, what time it's time for the Tokyo session? Currently it's around 10 p.m. Nigeria time to about 6 a.m. Nigeria time. This is the time zone for Tokyo session or Asia session. Now, another session we have is the London session. This session is the most active session because it covers activities in Europe and Africa. Well, you might be asking yourself, why Africa? This is because it is London session, of course, belongs to Europe, but most Africans find themselves trading during this period because they share almost similar time frame with those in Europe, with those in London. The time difference is about 1 hour in most cases. Now, during London session, we want to trade currency pairs that contain the euro, the Great Britain pound, which is GBP, and the Swiss franc, which is noted as CHF. This London session enjoys the largest liquidity, especially during the overlap with the New York session. What does this mean? It simply means that enough liquidity, enough money comes into the market during London session, especially during overlap with New York session. We're going to give that overlap time frame shortly. But the time for London session currently is around 8 a.m. New York time. 8 a.m. Nigerian time to 4 p.m. Nigerian time. The third trading session that we have is the New York session. The New York session has the highest volume in the market, as a lot of big companies and commercial financial institutions are situated in the West, in the United States. So this makes it easy for the market to have enough volume. Now, the New York session comprises the markets in the North and South America, and during this session you would want to focus on currency pairs that contain the Canadian dollar and the United States dollar, basically. Now, what time is the time frame for the New York session? We have currently from 1 p.m. Nigeria time to around 9 p.m. Nigeria time. So far we've talked about 3 trading sessions: the Tokyo session, which is otherwise known as the Asian session, the London session, and of course the New York session. So now that you know about these trading sessions, what would be the best time for you to trade? Well, in as much as this question can be answered by only you, it is also important to know the differences between these sessions and how you can take advantage of them. The question is, how do you know the best time to trade to enjoy liquidity? You obviously do not want to trade during a time where there is not enough liquidity in the market. For example, the Tokyo session will not be ideal for you to trade because at that period market is very slow. You won't enjoy enough liquidity. This means there will be not enough movement, and if there is not enough movement, you can hardly make money from the markets. So while you consider that, you would also consider the economic calendar. I mentioned something about technical and fundamental analysis earlier. Now, the fundamental analysis has to do with economic calendar, and of course, we'll get there on how to use this for the financial market. So, with these 2 points in mind, you would also want to consider, in addition to that, a time frame that you would be able to trade, which won't really affect the time in which you sleep or the time in which you carry out your usual daily activities. So you might want to avoid this as much as you can. Now, brokers. What are brokers? Well, brokers are simply intermediaries that connect you, the trader, to the market or to the liquidity providers. So we would paint a picture of how the forex market looks like. Now, imagine a market where people go to exchange any types of product sector. Just think of any type of products. The market is always crowded with buyers and sellers of different kind of stuff. Now, when you get there as a buyer, you may get stranded trying to find a seller of your product. And if you're a seller, you may get frustrated because you don't seem to find buyers for your product. Why is that? Because it is a random market. There is no orderliness. That is exactly how to describe the role of a broker. Now, brokers, on the other hand, they are like middlemen. Now, imagine the illustration we just gave about being in the market as a buyer. You cannot find your way because there are so many sellers, and you just can't find what you're looking for. And then you, as a seller, you're trying to find buyers for your products. You're frustrated because your buyers are not able to find you for them to get your products. This is where middlemen comes in. This is where intermediaries comes in. You might go to some markets, yes, and then you'll be seeing some random people holding you by your hand, like asking you, what are you looking for? I have it. What are you looking for? I have it. Well, in real term, they do not really have what you are looking for, but they can help you with whatever you are looking for, because they are so familiarized with the market, so they can take you anywhere to get whatever you're looking for. Now, the question you'll be asking yourself is, why would they want to do that? Why would they want to go through that stress of taking you around and showing you through the market? Well, this is for personal benefits. They know that once they do that for you, you would likely tip them. You'd like to give them commission for what they've done for you, because they are helping you to get to your seller. And then on the other hand, some of them must have had a deal with the sellers already, telling them that, look, anybody I bring to your shop to get things, this is the percentage you're going to give to me, percentage of whatever they're buying, or this is the fixed amount you're going to give to me. So in any way at all, these middlemen, they are collecting commission from either you, the buyer, or the seller, or both you, the buyer, and the seller at the same time. Now, brokers are like these middlemen. They provide a relationship between the buyers and the sellers. So when you get to the market, whether you are a seller or you're a buyer, your broker will help you to get a deal as fast as possible. Now, in the Forex market, you buy and sell currencies and assets in split seconds. This is with the aid of a broker. The broker gets his commission, which is known as spread, when he successfully executes a deal for a buyer and a seller. It's just like the example I was giving. The broker would get their commission, which might come in form of spread or just commission, once they successfully execute a deal for the buyer or the seller. Now, there are two types of brokers. There are two types, or majorly two types of brokers. The first type of broker is the dealing desk brokers, and then the second, they are the no or the non-dealing desk brokers. So this will take us down to the next module. Types of brokers. As mentioned, we have the dealing desk brokers. The dealing desk brokers. These are also known as market makers. The dealing desk brokers, they are known as market makers. They are Forex brokers that operate through a dealing desk, and they make money through spreads, providing liquidity to their clients. Now, dealing desk brokers, they create a market for their clients. This simply means that they often take the other side of the client's trade. Now, while you might be thinking that there is a conflict of interest, there really isn't a conflict of interest. Market makers, they provide both a sell and a buy quote, which means that they are filling both buy and sell orders of their clients. This is what you have to know about dealing desk brokers. How about the other category of brokers? These other category, as the name suggests, they are the no dealing desk brokers, which means they do not pass their client's order through a dealing desk. The dealing desk brokers, they pass their clients through a dealing desk, but these non-dealing desk brokers, which are the NDD, they do not pass their clients through a dealing desk. This means that they do not, I repeat, they do not partake on the other side of their client's trade, as they simply link the two parties together. Now, no dealing desk brokers, they are like bridge builders. They build a structure over an otherwise impassable or hard to pass terrain to connect two areas. Now, no dealing desk brokers, they can either charge a very small commission for trading or just put a markup by increasing the spread slightly. So what would be your choice of broker? Would you choose the dealing desk brokers, or would you choose the no dealing desk brokers? Now that we've talked about brokers, quickly we also have ECN brokers, which are the electronic communication network brokers. Now that we've talked about the major brokers, from the comments you would already know that some of these brokers are genuine and some of these brokers are not genuine. In fact, they are scams. We have different scam brokers out there where people have lost money, brokers that are not legal, or brokers that do not have good regulations, so we cannot completely trust them. So the big question is, how do you protect yourself against scam? When I mean scam, I mean against brokers that would likely want to scam you. Well, this will totally depend on you. There are lots of legitimate scam activities that brokers practice. Even the ones that appear to be genuine, they have some fraudulent activities going on with them. We have problems with spread, with margin, with entry points, with slippage, and whatever the case may be with most of these brokers. And then when you write to their support, they will not give you any good explanatory service. They will not refund your money in most cases. So how do you protect yourself against these brokers? Number one, you check for their regulation. Check if these brokers, they are well regulated. We have different forms of regulations. Yes, some of these brokers, they might come to you and tell you they are regulated. The question is, do they have good regulations that are recognized around the world, or they have gotten some cheap regulations that you don't even know of, that you feel is good enough? Now, after ensuring that your broker is regulated, make sure that you take legal actions if you see any suspicious activities in your account. And then finally, have a trading journal. Have notes of everything you do while you're trading. In this way, you can keep good records of where you picked your trade, where you put your stop loss, where you put your take profit, so that whatever happens, slippage, spread, or anything, you can have good details of what really happened without cracking your head and no evidences. So on this note, I'm going to do a recap of what we've done so far. We are, of course, talking about introduction to Forex. And then the first thing we did, we defined what Forex is. And then we said Forex simply means foreign exchange. Forex simply means foreign exchange. And we said in Forex there are different commodities, currencies, and things that we trade, things like oil, metal, cryptocurrencies, futures contracts, stocks, and the list goes on and on and on without end. And then we went further to talk about the history of Forex, how it started through trade by barter down to the era of gold and then paper money, and we linked that to demand and supply, which we would hear often in our trading almost every single day. And then we talked about what is being traded in the Forex markets. As mentioned earlier, we have metals, we have oil, we have currencies, we have cryptocurrencies, we have stocks, we have bonds, and the list goes on and on. And then we went further to talk about Forex market participants. We mentioned 4 different Forex market participants, which are the governments, we talked about the central banks, and then we talked about commercial banks, and then we talked about retail traders, which include myself and of course you. Then we talked about cash flow. We know that money do not readily stay in one place. The mistake that most people do is that they want to chase money, but they do not know that one of the most important things is to know where the money will go next, because obviously the money will go to where there is demand next. Even if we know that there will always be demand and supply, the money will always want to go to where there's demand, and the big boys in the market, they know this. You should also know this, so that you can know how best to trade with this information. Then we talked about Forex trading sessions. We talked about the Tokyo session, which is also known as the Asian session. We talked about the London session, and of course we talked about the New York sessions, and we gave different time frames in which you can actually trade these sessions. Finally, we talked about brokers. We defined what brokers are. We said they are intermediaries. They are the link between you, the buyer, and the seller. And then we talked about types of brokers, which are dealing desk brokers and no dealing desk brokers. And then finally we talked about how you can protect yourself against scam, against bad brokers, and then against even good regulated brokers that do not do what is right. Now, in our next video, we're going to talk about Forex jargons. Remember earlier I mentioned that Forex has its own terms, Yes, we're going to talk about that in our next video. If you enjoyed this video, I would appreciate if you can give it a thumbs up, you can subscribe, and of course share this video. And until next time, I wish you good luck and be safe.